everyone. Welcome to Unicus TV in this edition of Inside the FASB. I'm Ganapathi, founder and CEO of Unicus Research, a long-shot investment research firm. I have with me here Fred Cannon, board member of FASB. Together, we are going to dive into the key updates made by the FASB over the last month or so. Fred, welcome back.
Oh, well, thank you so much for having me, Lax. It's good to be back on. And as always, I will put out my disclaimer that I'm speaking for myself as one board member, not for the FASB as a whole.
Thank you very much, Fred. Transparency is critical for public and private companies, and we touched up on this last time so that the investors know what is going on with the companies. Let's talk about a popular financing technique called supply chain financing. I know it can be a perfectly useful financing tool in the right hands, especially companies with healthy balance sheets, but it can also disguise shaky credit situations and allow companies to go deeper into debt, often without the knowledge of investors and analysts, with some dangerous, disastrous ends. And Fred, to this point, last week, FASB announced that it has issued a new accounting standards update that enhances the transparency surrounding the use of supplier finance program. Now, what is supply chain financing and what drove FASB to issue a new ASU?
Well, thanks, Lax, and I think you touched on it. Essentially, what supply chain financing is the inverse of what we typically think of, and that is account receivable financing. So essentially, this is account payable financing. So for example, a large retailer working with a financial institution, will allow their suppliers, small entities often, to get paid earlier than the payment requirement by the retailer. So for example, essentially a retailer is, pays in 90 days. Small companies that are supplying that company would often like to get paid in less than 90 days. As we know, those type of companies often are cash short. And essentially, what happens is that retailer will work with a bank and say, hey, we have a program for you, supplier, that if you want to get paid in 60 days or 30 days or 15 days, the bank will arrange that payment for you, obviously with some financing charges. And so that's really the basis of it. Now, as you suggested, this can be very benign and just a positive practice insofar as the bank is actually using the credit strength of the retailer, usually and often a large, maybe a very highly rated company, to extend some credit to the smaller companies who often don't have that. So that's can be seen as a positive. However, I think on the other side, one of the things that this can also be used for is, say that retailer is getting into a little bit of a constraint and says, boy, I'd really like to extend my payments to all my suppliers from 90 days to 180 days. And then essentially working with the bank, they may be able to say, hey, we're going to extend our payments, but just make sure that all of our suppliers can still get paid in 90 days. And, the challenge here is that these programs, there's been no transparency of these type of programs. And so users have really reached out to the FASB and say, hey, we need to know about these. We know these programs are growing. We know they're extending. And on the one hand, we recognize, as you had mentioned, that these can be perfectly fine and helpful. On the other hand, if large companies are using this to extend their payments, that's somewhat could be seen as hidden leverage or increasing debt. And it's something that financial statement users need to know.
Thank you for clarifying, Fred. So they haven't mentioned this in the financial statements so far. Is that the lack of transparency that is worrisome?
Correct. There's been no accounting standard that requires this. As a result, there have been some voluntary disclosures by a few companies.
Mhm.
There's been some kind of well-known, especially in Europe, some issues of companies having significant problems as a result of this. But there's been no required disclosure. And so that's really was users reached out to us and said, we need to know about this. Now, we took a disclosure only approach. Essentially, we said companies can need to disclose this in the footnotes of their financial statements so users can analyze it. And we think that the data that they're going to get starting next year is going to be very valuable. Some users would have preferred us to essentially call any extension of this payments as additional debt, or put this in the statement of cash flows, or change where it is on the balance sheet. We decided that we could get the information out quicker to users through disclosure, and then those users can adjust their own metrics of the company as a result.
Okay, so when they are using their own model, they can factor that in and do the projection if need be.
Exactly.
Thank you. That's very helpful. Now, another question is Libor. It has a dark past. FASB, recently, I read it in the news that FASB has extended Libor relief for 2 more years. Is there an underlying reason you could share with us why? I think technically it was supposed to be done by 2021 December, if my memory serves right. What's the reason behind this extension?
The extension is really quite simple. It's just that the regulators extended the time period of the transition away from Libor. And so the transition away from Libor has to be done by 2023. And we felt it would be good to allow essentially our Libor transition support past that. Really, all that the FASB is doing is saying that, hey, if you have a contract in Libor and you move it to one of the other allowed benchmarks, particularly SOFR, that you don't have to go through the accounting for a brand new contract.
Got it.
Because if you went through the accounting for, like that contract ended and this new contract began, that gets very complicated, and it actually could cause some movement in the income statement that wouldn't be of value to users. So really, it's just to ease that transition away from Libor. We also discussed whether or not we would add other benchmark rates into that transition.
Like what?
Well, there was, we've been requested to add a Bloomberg index, BSBY. We've been requested to add a Maribor, which is another index. We also were asked to use, currently we allow overnight SOFR, and we were asked to push to increase for term SOFR. We didn't agree to that. And the reason is that we view that as an extension of hedge account. I viewed this as an extension of hedge accounting, not as helping in the transition from Libor. So I think that we may address those issues at a later date, but really this is just simply to help this transition away from Libor, which, as you said, has had a sullied history. Yeah.
Well, thank you for clarifying that. Now, what is I'm trying to understand, I'm sure our viewers are trying to understand, both investors as well as consumers, what is phasing out the Libor means to the investors? How does it affect them?
I don't believe it's going to have a major effect on investors in the near term. In other words, essentially what's going to be what had been Libor contracts. Now the banks will use any array of other instruments rather than Libor as a benchmark for what's in a contract. So, for example, you might get a call from the bank and say, "Hey, your mortgage is tied to Libor. We now would like, if you agree, we'd like to change it to prime or to 6-month Treasury notes or 3-month Treasury notes." I think for most both investors of companies, that shouldn't have a major effect on the health of the company, or in terms of, especially with kind of the ease at which we have that change in contract will be fairly straightforward, and we don't believe, now you always have to be careful, that there won't be a significant basis difference between contracts that were written in Libor to contracts now written in something else. And hopefully, if there is a major change, that'll show up in the income statement.
Thank you. And what is it? I think you addressed it a little bit. What does it mean to the consumers? I know it touches Libor, the floating rate touches on home equity loans and credit cards and auto loans and so many other leveraged loans. So what do you think? How does it affect the customers, or it doesn't affect them that much?
Well, it shouldn't affect them that much. I mean, I think most consumers view whatever their short-term rate they get in terms of the contract with the bank as somewhat indifferent, right? I mean, let's see, do I have Libor? Do I have a 1-month treasury that's the index? Do I have prime rate? Do I have Fed funds rate? I don't think, consumers, especially on a day-to-day basis, just view this, hey, I got a variable rate loan. And if rates are going up as they are today and I have a variable rate loan, I'm getting a statement from the bank to tell me that's going up. And whether it's Libor or it's one of these other benchmarks will have, in my view, not a major effect on consumers. They just, especially in this environment, that their payments are going up.
So they wouldn't really notice that much.
They wouldn't notice the difference between Libor and some other index. They're sure going to notice that their payments are going up.
That I'm sure that they will definitely notice, unfortunately. Thank you so much, Fred, for joining us today and answering all our questions. And we have more to cover over the next 2 weeks. And thank you all for listening. Until next time, this is Lux Ganapathi, and please reach us at info@unicusresearch.com with your thoughts and about our interview today. Thank you.